welcome and thank you for joining episode 2 in season 3 of the Scotia Live webinar series. My name is Sarah Cumming, VP of Capital Markets at Scotia Investments. In today's session, it is going to be an exciting one. We're going to be talking about money and how you can maximize the returns on your investments. Today's topic is the new money mindset, breaking down IPOs, APOs, and more. Since the onset of the pandemic, financial markets have been volatile, caused by the heightened uncertainty. Investors are concerned about their portfolio's performance and are looking at ways on how they can make more money to meet their financial goals. IPOs and APOs have been a trending topic. In today's discussion, we'll be defining these terms for you and discussing how you can assess these opportunities. Why do companies come to raise equity in these markets and how this can benefit you? I have with me today my esteemed panel of colleagues, Kevin Walters, Senior Investment Strategist at Scotia Investments, Nerese Pottinger, Senior Investment Advisor, and my colleague Stanley Thompson from Capital Markets. Please join us on Zoom as well as our Instagram page at Scotiabank Jam. We invite you to send your questions in through these platforms and we'll do our best to address all your questions. Let me open the session up by helping you understand what an IPO and an APO is and what the definition. Stanley, can you help me out here?
Sure, Sarah. Thank you very much, and thanks to everyone who joined us this evening. So, when a company is formed, the founders generally put in capital in the business, usually in the form of equity. That's their shares in the company. Now, if the company wishes to raise additional funds because it's looking to expand, they can either go and raise funds from friends and family, or they may go to the public, the wider public, to raise capital. If they go to the wider public, then they're issuing shares under the regulations on a stock exchange in an initial public offer. So this is the first time the company would be making shares available to the general public for them to participate in the ownership of the company. An additional public offer is now when that same company that is now listed, having made an initial public offer at some other time in the future, decides that it wants to raise additional capital by issuing more stocks or more shares in the company to the public. This is what you term as an additional public offer. Any other offer after that initial offering would be termed an additional public offer.
Thanks, Stanley. In terms of companies coming to the market, why would a company come to the equities market to raise capital?
Very good question. Well, we could look at it from a strategic and financial point of view. Strategically, when you're listed, it raises the company's profile. A company that is listed, it has better governance because it now has to adhere to the rules and guidelines of the stock exchange. You have more analysts looking at the company's number and scrutinizing the performance of the company, and you have a wider shareholder base that basically keeps management, in line and keeps them operating to the standards that these various investors expect, which is not necessarily the case of a public company. It also gives the opportunity for the company to introduce stronger governance practices, as I mentioned, because it now has to adhere to the rules of the stock exchange, frequent reporting, putting out your financial statement on time. Also, the composition of your board, the stock exchange has various guidelines on how the board has to be made up. And another key strategic benefit is that it will help ensure continuity. So you may have a company that the founders started many, many years ago, 30, 40 years ago, and they're now at a stage where they may want to, slow down, retire. Now, by listing on the stock exchange, you have all these different guidelines that the company now needs to operate by, all these different groups that are scrutinizing the company's performance. The shareholders can then step outside of the company and the company continues to operate in a manner that is, in line with what would result in continued good performance. Strategically, that's a strategic reason. On the financial side, which is generally the most important reason companies list, is they want to raise additional capital. So by listing, they raise additional capital from the market. It also allows them to get tax benefits in the case of the junior market, because the junior market currently offers 10 years of tax breaks for companies that are listed on the stock market once they stay listed for 15 years. They can also use the cash capital raised to pay down maybe expensive debt that they may be carrying on their books prior to being listed on the stock exchange. And it also allows the company to give participation to employees. Employees generally work for a company and expect to get a salary. But when companies list, they tend to reward employees by allowing them to participate in the ownership of the company. So those are some of the, I'd say, strategic and financial reasons why companies may choose to list.
Stanley, I'd imagine that an important consideration about when to come to market is evaluating the market conditions. How do market conditions affect an offer?
Very good question. Now, from the perspective of the company that is listing, that is the company trying to raise the capital, you need to be aware of what's happening in the economy. So, for example, if there's a lot of liquidity, meaning if there's a lot of cash in circulation, then investors would be likely, you'd have more investors participating in your offer, all right? A key factor is also what are expectations for the economy in terms of the performance of the economy going forward. Investors generally place their funds in an asset based on what they expect as opposed to what is happening in the current situation. So if investors expect economic conditions to improve or to be positive going forward, then they're likely to participate in the IPO by buying more assets. Mm-hmm. If, however, they think there's an economic downturn coming in the near or in the long term, then they may be hesitant. So it's important for a company looking to list to pay attention to what are the conditions around interest rates, for example, because if interest rates are expected to increase, then generally investors tend to shy away from making long-term purchases like buying stocks.
Thanks, Stanley. I think you've laid a very good foundation for us in moving forward on how it is that we would approach assessing the value proposition of an offer. So with that, I'd like to turn the discussion to my colleague, Kevin. How do we assess the value proposition of an offer? What should we consider?
All right, thanks, Sarah, and good afternoon to everyone who has joined. All right, so when we think about APOs and IPOs, and I know the terms have been very popular over the last couple of years, and the popularity has coincided with just the overall substantial performance of the market over the last couple of years. Now, there's a certain misconception. A lot of investors think that IPOs and APOs are foolproof investments. Once you go in, you're always going to benefit, but that's not necessary. That's not always the case. And as such, there are certain recommendations that, we would advise investors to take into consideration before they make that decision to invest.
Thanks, Kevin. What would be some of the key things as a potential investor? This IPO comes. Is there any, where do I find information?
All right. So, for prospective investors, I think the perfect place to start is with the prospectus. Now, what is the prospectus? The prospectus is a legal document, that is required by the FSC, is also required by the JSE for companies that are making a public offering to the market. And there are certain key information in there that, investors should look at before they make a decision whether or not to invest. And we kind of go through the list, and this list is not exhaustive. There are things that we may not capture here, but these we think are some of the most important things. First, defining the business. It's always important to know what you're investing in, right? And, for IPOs in particular, a lot of these companies were private before and coming public. It gives the investors a chance to understand the business, understand, what sector they're in. Are they in the financial sector? Are they in the manufacturing sector, retail? So understanding the business is very important before you make an investment decision. And that also flows into identifying the company's strategic goals. Stanley spoke a little bit about, what the goals are in terms of when companies come to market, and you want to ensure that these goals are aligned with, just your overall expectations. And, that is also captured in the purpose of the offer. So, when a company is coming to market in the prospectus, they tell you they're raising capital for this purpose or that purpose. And, you just want to ensure that these are aligned with just your overall long-term expectations. Size of the offer is also very important. Now, it is important in the sense that, you will know whether it's going to be listed on the junior or the main market, and that will give you a sense of what the secondary trading will be in the issue. So that's always something that is important. And senior management profile is also very important. So when a company goes public, you then get to still assess the quality of the board, senior executives. You look at their profile, their background. Are you confident that these persons are have the required expertise to take the business forward? So that's something you always have to look at. And then, and Stanley would have mentioned it, there are companies that, would have existed a long time, they were private. You get a chance to look at what their financial history has been like. And that's always important to consider. Now, after you do that, after you've read the prospectus, then it's time to take it to the next stage. And the next stage involves, you may have some additional questions. At this point, you'd like to seek professional advice, and you may reach out to my colleague, Neris. And at this stage, you and your advisor, you look at the potential offering, and you look at your current portfolio setup, your current long-term goals, etc. And then you see how that fits in, and then you start to mold your investment thesis. Now, your investment thesis is basically your reason for investing in this offer. Mm-hmm. It may be an opportunity to gain ownership in some company that's previously private, and then we saw that with companies like Wesinco and Fontana, household names, mm-hmm. companies that we knew about, and when they decided to go public, people really latched on to that opportunity. So that may be what you're looking at. Attractive valuations, again, when a company is coming to the market, they'll look at the macroeconomic conditions, and they'll try to price the offer in a way that will incite investors to participate. Stanley also spoke about the increased regulatory requirements. So, once you've made that investment, you'll get frequent updates, and you can understand whether or not, things are still on track. Now, in that session with Neris, you'll also look at, the potential risk. You always have to counterweigh, the potential upside with the risk. And for some companies, in some cases, an IPO is considered a risky investment because for startup companies that don't have a proven track record, you may have to, really take a deeper dive in terms of what their value proposition is. For APOs, it's potentially dilutive, and I'll speak to that a little bit. And Stanley would have indicated earlier, when you talk about an APO, you're talking about a company who was already public issuing additional shares. Now, when you look at the barometer for profitability, that is earnings, right? Or earnings per share. Now, when you think about earnings per share, that is the net income divided by the amount of shares you have outstanding. So instantly as an APO is issued, the first thing that increases is the amount of shares outstanding. And it will take some amount of time for that capital to be put to use to increase net income. So as an investor, you always want to consider this. So you may either decide that you may want to increase proportionately how much you invest, or you really want to assess whether or not this will turn into future value before you get involved. And last but not least is the increased volatility. And at the start, I spoke about people really thinking IPO is like a meal ticket. So a lot of persons will go in and come out right as the offer starts trading. Mm-hmm. You also have persons who probably wouldn't have gotten the allocation that they wanted, and they are looking to get that allocation when the market opens. So you'll tend to see a little bit of volatility in the first couple of weeks or, in trading. So that's something to consider. Now, us, as in, the portfolio advisory team at Scotiabank, we take a similar approach, but we get a little bit granular. And on screen here, you'll see, what our approach is essentially a 5-step approach. First we start by understanding the business. we forecast the company's performance, we select the appropriate model, and then, we turn those forecasts into valuations, and then we arrive at a conclusion. So let's take a deeper dive into understanding the business, and I spoke about it earlier. When you're starting to understand a business, you want to look at the competitive environment. Where's that company in the structure of the industry? Are they a market leader? Are they a price taker? Do they have pressure from suppliers? Do they have pressure from consumers? All those things you want to consider, and then you want to look at the financial statements. You want to look at what is the quality of earnings. And what do I mean by quality of earnings? Now, quality of earnings is how persistent and consistent earnings have been over time from the core business. And that's very important. So, we take out one-off things and, one-off either gains or losses to normalize and look at what the quality of earnings is. We also look at the company disclosures, because a lot of information, is contained in the disclosures, and we see if there are any strategic changes taking place. And after we've done that, we move to forecasting the company's performance. And, this is a pretty involved process, and we take a top-down approach. So generally we start, we may even start as far as the expectations for the global economy. Then we take it continental, we may go to the US and some of our key source markets. And then we take it regionally, and then we end up at Jamaica, and then we go to the industry level. And after we've made those assumptions and done those calculations, what we do is then project the three main financial statements: the income statement, the balance sheet, and the cash flow statements. Now, finally, after we've done all of that, the most important thing, and this is what investors want to know, what is the proposition? What is the value proposition? So our reports typically have two values that you look at the end of the report. We have the intrinsic value or the fair value, and we have the target price. And what we look at, we take those forecasts that we made before in terms of, and on the absolute side, we take those forecasts that we've made before into the future. We look at what the strength of the cash flows are going to be like, what our expectations are, and then we take those future values and bring them back to today, discounting it back to today, and see what the value of the company is. And we compare that with the value that the company is offering, and then we'll give our insights in terms of whether or not we think this is an offer you need to look at. From the target price perspective, it is more of a relative value. So we look at the value that the company is offering, and then we take a subset of key peers and compare that value to what they're offering to see whether or not this offer is perfectly placed for the investor. And, it's much more involved, but I'll leave it there for now, Sarah.
Thanks, Kevin. Very comprehensive approach. Just to summarize, we need to understand as investors key terms within the prospectus. Once you're comfortable with that, seek some professional advice to make sure that this does fit in with your investment goals. And very clearly, we have a portfolio advisory group that does a detailed analysis of most of the offers that come to market, and they put forward their recommendation based on a very comprehensive valuation process. So let's talk about the market, right? Kevin has been very busy, but Stanley, I know you have been at the forefront of many of the offers that have come to market. Can you give our viewers some information about what the market activity has been like, and what kind of returns have investors been able to achieve?
Sure. So for companies looking to raise capital, they'd be happy to know that, over the last 3 years, over $50 billion have been raised on the market from companies doing either IPO or APO locally. So that is really a large number, when you consider that this is everyday Jamaicans participating in an offer. And even, in 2020, there was where the COVID pandemic basically, landed. We still saw a lot of offers being successfully completed in the market. There's Trans Jamaica that raised about $14.4 billion. This was just before the pandemic came. And then there was the Barita APO that was about $13.5 billion or thereabout. And this was, around September or thereabout, after the pandemic was a thing here. So there are still, despite the pandemic, there has still been a lot of activities in the equity market, and Scotia has been, able to offer this to our clients because we're selling agent on the two offers that I mentioned, as well as others. In terms of returns that investors have seen since, if they would have participated in either of these in these type of offers, I mean, they vary right now. I mean, looking at offers like Mailpack and Fesco, returns were like up to today were about 272 thereabout percent returns. But there's also been offers where the returns, if you look at the point-to-point return from this point relative to when they initially came to market, the returns have been negative. As Kevin mentioned before, not all offers effectively give you a positive return depending on when you look at it, and also given market conditions, because companies are going to be subject to market conditions. Depending on what's happening in the market, their performance may be down. You have some offers as well that are linked to the general performance of the market, like you have the Sagicor Select and the QWI stocks. These are companies that are going to be susceptible to the general performance of the market, and so when the market is down, they tend to be affected likewise. But you look at it from a balanced portfolio. If you look at it, generally across all the offers, investors would have been better off participating in these offers generally.
Thanks, Stanley. It seems like the mantra of buy, hold, and prosper, I guess once you've done the requisite analysis, seems to be the right approach. So right now, let's take a pause and move to some questions from our audience. Okay, this one comes from Gregor's kid. If I want to grow my wealth fast, are IPOs, always the best way to go? Stanley, can you give us a response there?
Sure. So what I say is, when you're building your portfolio to generate wealth, you want to build a balanced portfolio, and a portfolio that matches your risk profile. It's not just to say, I want to build it fast. You have to look at what kind of risk am I willing to take to build my portfolio to get to the returns that I want. Also, you want to bear in mind that IPOs are just one ways that you can get involved with equity. If equity is what you're looking to participate in, there are other companies that would have been listed on the stock exchange before. Whether or not they're doing an APO, you can also buy the stocks of companies already listed, and there are actually companies that have performed very well on the stock exchange. When you look at over the same period that I just disclosed regarding the IPO and APO offers, that have returned even more than these numbers. So the best thing to do in this instance would be to go and speak to your wealth advisor, get the advice, because the wealth advisor is trained to match a portfolio that matches your risk tolerance, and also looking at your objective, and will get you there safely.
Great. We have another question at Chelsea FC fan. Nerys, I think this one's for you. Can I assess an IPO myself? If I know the name of the company and it's popular, can I just invest?
I would say no. You definitely want to contact your investment advisor. We have the skills and definitely the research team behind us in order to give you the type of quality information you need in order to effectively assess the offer.
So this one is coming from Lauren Teal. Kevin, she's asking, is buying an IPO stock always a good investment?
So I think the answer to that is no, not necessarily. We've seen, and I spoke about it in the presentation, that majority of the offers have proven to be good investments over time. However, we must always remember that IPOs, particularly if they are startups, there is a certain amount of risk involved. And there's even risk involved in APO also for companies that are potentially raising funds to go into an area they don't have, a lot of expertise. So it's always good to properly assess the offer. As I said, read the prospectus, speak to an investment professional, and listen to what the research analysts are saying, because, we would have done substantial work to give you that type of information. So, no. But, potentially a good opportunity after you've done your due diligence.
So, Kevin, just to follow up on that, you mentioned the prospectus. Can you just remind our viewers what is the most important thing, or what are some of the key things, high-level things that you should pull and consider to review when looking at the prospectus?
All right, fine. So I'll do 3, right? Understanding the business, and that's very important. So you have to ensure that this is something that you believe has a sustainable future, not necessarily something that is going to disappear in the next couple of years. So understanding the business, understanding the industry, and also what is the purpose of the offer? Do you think that this is something that is going to be viable? Do the analysts support the use of funds? Is it something that's going to generate consistent earnings? And just to choose another one, I think the company profile is very important. You have to look at the senior management team. You have to look at the board of directors. You have to get a sense of, what their backgrounds are. Do you believe that these guys or, these people are the persons that will drive the business forward? And I think that's very important to assess. And as I said, there are more things, but I'll just stop at those 3.
Just to round it out, Kevin, because it's a question that we want to consider relative to market. So let's say a company comes out. Me as an investor, do I care whether or not I believe their offer will be successful? Meaning, you told us to look at the issue size, right? How much are they coming to market to raise? As an investor, do I care if I believe that they're going to raise that amount of money?
Yes, and one of the reasons why you should care is, a lot depends on how much money they are raising, and that will be outlined in the strategic objectives of the company and the purpose of the offer. Now, if the amount that's being raised doesn't match the ambition of what they're trying to do, and you look at their financial and their retained earnings or equity position does not support it either, then you really have to dig a little deeper to see how they're going to achieve some of these objectives. So I think that's very important. It's also very important to, again, tie it back to the purpose of it and to get a sense of whether or not the market believes that, this will be a viable investment option.
Great. Thanks a lot, Kevin. Very, very insightful information. So for this part of our segment, we want to turn over to you, the investor, right? We've shared a lot of information for you to digest, and what we want to get to know is the practical side of the discussion, right? You as our potential investor, our client, how do you go about including IPOs in your portfolio? For this discussion, I'm going to hand over to Nerys, my colleague, to share a little bit more about this with us.
Thanks so much, Sarah. Good evening, everyone. So for me as the advisor, I get to focus on the most important person in any room for us, virtual or otherwise, and that's you, the customer. So a new IPO has come out on the market, all your friends are talking about it, and you want to invest too. So you take up your check, your savings for about $500,000, and you're coming in to talk to your advisor. What's the first thing that we're going to look at? It's really getting an idea of what your goals are, what your time horizon is, what your risk tolerance is. And once we have that investment profile in place, that forms a cornerstone for every conversation we have going forward. So when we talk about your investment goals, that's really focusing on your why. Why are you investing? Are you saving for your child's education, a property purchase, a trip that you're planning in another year or two? Or you're saving up your nest egg or planning for retirement. But that's always going to be the focus and how we structure the portfolio to achieve that goal. When we talk about time horizon, ladies and gentlemen, that's one thing, Sarah, I can tell you without a doubt. Customers come in all the time. They have a long-term time horizon. Okay, great. What do you define as long-term, sir? 1 year. No. 1 year is very short term. 5 years or more is long-term, and that's the ideal time frame that you want to have in mind when you're looking at buying any stock, including IPOs or APOs. And risk. So when we talk about risk, we're really talking about how much uncertainty or what degree of financial loss you're prepared to stand if you were to invest in anything at all. So I give you an example now. let's suppose you did take that 500,000, you put it on this IPO, and 1 year later you get your statement, you open it, and the 500,000 you placed is at 300,000. How do you feel on that? Is it just a pit in your stomach, or you can't sleep for the rest of the week? You're so upset about it. If the answer is, I can't sleep at all, Nerys, that's too much for me, then that's too risky a product for you. And then really, risk is like a scale, right? So we have I did 2 investment profiles for us to look at. And the first one is income and conservative growth. So cash is low risk. It's your rainy day money. It's your emergency funds that you have really easy access to. Income is longer term, principal is protected, you're getting a steady cash flow. But these last 2, those are the ones we're focusing on today. Growth and speculative, right? Those are the asset classes that our stocks and IPOs generally fall into. So for this customer, they can't take on as much risk as they thought they could. So the 500,000 would be weighted in different types of securities. So not everything would go towards one stock. No, we would invest it across different securities. And I think that's what's important when we talk about how we set up a portfolio that's just right for you. It's for your specific needs and goals. Another customer might have a more aggressive growth approach. And that could mean that they can have up to 80% of the portfolio in stocks. They can withstand that 200,000 dip easy because they know that they have a long-term time horizon. Maybe it's a young person just starting out, or a person that has a large asset base, and they're able to withstand that type of shock to their portfolio for the medium and long term. When we look at how else we can structure the portfolio, you say to yourself, boy, okay, Nerys, so I'm definitely not ready for aggressive growth. I'm probably closer to income and conservative growth, or maybe somewhere in between. So I still want to put some money on this IPO, but how do I invest the rest of these funds? What if I want to place some more money on other stock options? And the answer is, we have it right here for you at Scotia Investments. We have managed funds that you're able to invest in both Jamaican and US currency. So when we talk about our managed funds, and we're speaking about equity in particular, it's really a pooled investment where your funds, my money, thousands of other investors' funds, they're pooled together, they're put in a common account, and from there, those monies are invested by professional fund managers who are experts in analysis and research, and they invest it in different assets. So there are different funds to meet any objective. But right now, I focused on 3 of our equity funds for you. Our Premium Growth Fund is our Jamaican dollar equity fund. It's invested on the Jamaica Stock Exchange, and it focuses on companies like your Carreras, your Supreme Ventures, your Seprods, Caribbean Cement, you name it, it's a part of that fund. A lot of our household names are in this investment. In the last 10 years, the Premium Growth Fund would have done over 13.8%, and that is outstanding. Last year alone, the fund would have done over 16%. And for our Global Equity Fund, if you're saying, Nerys, I have some US, I want to know how to invest and diversify the portfolio. This fund does that for you. Sitting right here in Jamaica, you can have investments in China, Australia, Bermuda, Brazil, the US, and Canada. This fund has all of those countries incorporated in that fund. But if you say, Nerys, I'm sitting here, I'm watching Netflix, I'm on my iPhone, I just placed my order on Amazon, and I'm Googling upcoming IPOs for 2022. What can I invest in that's more specialized for that? And your US equity fund has all those companies included. All those household names are incorporated in the fund, and they're managed by our professional fund managers, and the fund would have done over 20% last year. So I think it's important for you to look at how we can incorporate funds like that into your portfolio, especially when we want to add equity and have a more long-term time horizon at play.
Great. Nerys, thank you so much. Very informative and insightful. From our side, it it makes me feel like, Scotia has really a tremendous amount of customizable options. I love the approach in terms of first sitting down with customers to say, listen, what is my risk tolerance? I love how you put that into perspective about, listen, if my portfolio is down, how do I feel about it? Time horizon is also critical. I love how you also put it into perspective of age and stage in your life. So I think the approach that Scotia Investment takes is key in terms of first understanding, as Kevin says, the investment thesis, the why. And from there, it seems like we are not limited to advising our clients to go directly into a stock, but that we can find them these incredible equity portfolios where they can get a balanced exposure and diversified exposure to get those returns.
Absolutely. Thanks,
Okay,
Sarah.
great. No, thanks a lot. So in terms of where we are in our segment, we'd like to move to some Q&A and hear from our audience. So this one comes from Zentry D. And I would ask this to Nerys. How do I purchase shares for any particular stock?
Sure. So you come in, you talk to your investment advisor. Once we have the discussion and go through some of the key benefits, the overall, research that we have for that particular company, then it's as simple as just sending in your instruction to us, and we get it done for you.
Great. Thanks a lot, Nerys. This next question is Sophia. Are you saying you can suggest where to invest and or buy shares? Nerys, can you answer that? Are we suggesting that we can? Sorry, I'll switch the question. This one is from Sophia. How does one get an investment advisor? We keep saying, all right, come and speak to your investment advisor. How does one get an investment advisor?
Sure. If you're an existing customer of ours, you definitely just call in and set an appointment. Especially now in these times with COVID, it's very important that we kind of manage the client flow in the office. So call in, set an appointment, and one of my colleagues or I are always so happy to speak with you.
Thanks, Nerys. This one comes from Patrick Forrester. Kevin, it says, with regards to financial institutions sending these offers to us as customers, should we just assume that they have been vetted by you and that you are advising us as customers? Or are we to obtain outside financial advice because you are on the deal and you're making commissions or rewards?
Right, so that's a great question, right? And, it depends on what or who the offer is coming from. So an offer is just an offer, but an assessment of the offer is different. So once you get an offer, you can read what the information is. You can, again, lean on the prospectus and see what additional information you can get. But at that point, after doing that, you come in and you speak to your advisor, and then you can get an actual assessment from the company that is complete and fair and free from bias, and what our actual recommendation is. And that is different from an offer. So the offer is just a solicitation to buy. Yes. The assessment is giving you the recommendation, identifying what the investment positives are, what the investment risks are, and what are our expectations for the company going forward. So two different things, same company, but you just have to speak to your advisor, get the proper information, and make your decision afterwards.
Thanks, Kevin.
Yeah, Sarah, I would also like to just add to the response. With regards to offers that are arranged by a particular broker and made available to the market, then the broker would have to have done the due diligence on the issuer to make sure that they are comfortable, because it's a part of our responsibility when doing an offer to make sure that we check make sure that all the statements are there. That we are comfortable with the issuer before we proceed to arranging a transaction, and that we show to clients. So that is the other part of us doing checks. So in addition to what Kevin is saying, if any of the brokers arrange a transaction, They are going to do all the checks, the due diligence, to get themselves first comfortable with that issue, or comfortable that this is an issue that they want to take to market and offer to clients.
Thanks, Stanley. Excellent point. Yes, certainly as arrangers, we are bound to do that due diligence. Scotia Investments, notwithstanding, we can act as arranger when it comes to market. And when we look to offer it to our clients or recommend it to our clients, an assessment has to be done. This is an objective assessment, as Kevin mentioned. It's undertaken by his team in the portfolio advisory group, and it's something that is totally objective, and a recommendation is based on, as he mentioned, the rigorous valuation process that him and his team undertakes. So we have another question here from Senior West. And I think probably, Kevin, you could maybe help us with this one here. How did you and the PAG team, for instance, evaluate offers at the beginning of the pandemic? And, maybe you can contextualize that to say if there were any offers at the beginning of the pandemic.
So no, there weren't a lot of offers at the beginning of the pandemic, and I would lean back on Stanley's presentation where he spoke about issuers who, they look at the macroeconomic environment, look at the uncertainty there, and decide whether or not it is time to make an issue. And going into the pandemic, it's important to say we're expecting a pretty robust year in terms of offers. Jamaica was the first one that was supposed to lead off. We were expecting offers such as JPS, etc. But when the economic environment switched, a lot of those offers have gone back on the shelf. They're slowly coming out. We expect to see more going forward, probably, towards the end of the year and into 2021. Now, for my team, we still had to do an assessment of, just the broad index of what we expected for companies that were already listed. Now, that was a very involved exercise. It meant losing a lot of sleep, right? Because the environment was so dynamic at the start where, things were changing rapidly, information was coming in rapidly. So what we basically did, we kind of looked at it from a top-down level, and we look at, putting things in green, amber, and red, and we said, okay, for instance, stocks that have exposure to tourism are stocks that's going to be very susceptible to this new environment. Stocks that are, in retail, selling food, etc.
Resilient, yeah.
These stocks are the stocks that are going to do well, and then we had some neutral stocks that we placed. So essentially, we created a framework first. We identified the high risk and the potential, and from there, we did more critical analysis. We looked at baseline crises before. So for instance, the most recent one was the 2008 one. No, there are a lot of similarities and differences, but we use that as a baseline, and we added some statistical analysis to kind of capture the magnitude of this crisis. And so essentially, we just got more rigorous. Our process got more robust, and we tried to look through the pandemic to see what the opportunities are, what the major risks are, and we applied all of that assumption and analysis to looking at offers at that point in time.
Very, very good, Kevin. As I said, a very detailed approach, comprehensive approach, especially with the pandemic coming on, and evaluating the risks. Simone Caterer from IG, and I'm going to ask this of you, Nerisse. How do I know if an investment fits with my overall investment strategy?
So, Simone, I think the first thing we have to go back to again is your why. So, the first thing I said was that your investment profile really sits as the cornerstone for our conversation. So, once it is that we go through that and we assess that it is in line with your risk tolerance and your time horizon and the goals you've outlined, then it's definitely something that we can look and see if, with a calculated risk approach, which is really the main thing that Scotia Investments really promotes, that you can incorporate that investment in your portfolio.
Thanks, Nerisse. There was an interesting question that was up, and it deals with more of the current situation. and it asked about it alluded to the BOJ, the recent BOJ rate increase, the increase in the policy rate. And Stanley, Kevin's World asked, how does the BOJ, the recent increase in the policy rate, how is that going to impact my assessment or valuation of an upcoming offer?
Well, that's a very good question. As I mentioned in my earlier presentation, investors generally look at what they expect and not, in terms of where the economy is going to go. As it relates to interest rate, for example, if investors expect interest rates to rise, to be rising going forward, then they will demand greater returns on their equity portfolio. To kind of compensate them for the additional risk that you're going to be taking investing in equities. Now, let me repeat that maybe in simpler terms. You look at an investment based on the risk, and if the risk of an investment is high, you basically want more returns, right, to compensate you for that additional risk. And so one of the ways you say, well, how do I know if the risk is high or low? You compare it to the returns you'd get on assets that have lower risk, right? So fixed income are generally considered to be fixed income investments like bonds and are putting your funds in a fixed deposit is generally considered safer than buying equities. And so if the interest rate in the economy goes up, then the returns on fixed income assets generally tend to be higher. So if the returns on fixed income assets are increasing, then the returns that you now expect on your stocks or your equity portfolio, which you consider riskier, would therefore have to be higher. And so the impact or what it means then is that, companies will have to either deliver better returns or investors are going to pay less for stocks in order to ensure that they're getting more value to compensate for that additional risk.
Great. No, Stanley, very, very insightful there. We have a question from Andre Austin Zoom. And Nerys, you had alluded to it earlier, but his question is, how long do we need to invest these funds to actually see returns on our investment?
Well, if we're talking about equity funds, then we ideally encourage the customer to have a long-term time frame, a 5-year time frame for the investment. That does not mean that during that 5 years that you're not going to be, checking on the portfolio or evaluating whether you're in a profit position at this point, or if it's down, why it's down. So all of those things are questions that you usually ask when you review your portfolio with your advisor. And when you do have a profit position, I always encourage the clients to review and consider skimming some of those gains off so that you're actually realizing that profit. It's no longer a paper profit, but something you have in hand that you can use for the future.
So, I'd like to add a little bit to what Neri said in terms of how long, and she hit some very important points in terms of your time horizon. So when we speak about equity, we speak about equity from the perspective of long-term investments because they tend to ebb and flow with the economic activity. Now, I want to draw on a particular example. Last year, equity markets around the world collapsed at the onset of the pandemic. Now, that created a lot of opportunity for persons who are outside of the market, and so the collapse was broad-based. It was indiscriminate. Good stocks fell off also as well as bad stocks. So, it created an opportunity at that point for a lot of persons to enter. And if you look at our U.S. global, our U.S. fund, you'd have seen that even in the pandemic, because of, I guess, the substantial support that came from the U.S. Federal Reserve and the government, those stocks would have had significant performances during the crisis. So when you think about it, you must always think long-term and not just look at one-year performance, and over a long-term, stocks tend to outperform most other investments. So it's not about, looking to get the return this month or next month, or it's about your entire investment horizon and, how long can you stay invested.
Very, very good points, Kevin. I mean, I think one of the points Nerisse just, hit on softly, though, is how we go back and reevaluate things, right? That this doesn't have to be a static, I buy and hold in perpetuity, right? The option and the availability is there for clients to reassess, market situations and trade out of a particular equity and trade into one, as you mentioned, Kevin. At the onset of the pandemic, you had to do just that, make an assessment. Who are going to be the winners or the resilient companies? Do I want to be more heavily weighted in them and trade out of these other stocks? Or, as you said, my time horizon does allow me to wait, hold, and see on some of the other stocks that could have been affected by the pandemic. So this is another question we have here. So this is for Nerisse, because she was sharing some statistics with us in terms of how our equity funds have performed, right? So when you say the global equity fund has done over 20% last year, I don't know if that was the exact amount, but how does that translate to the customer? In other words, what do customers see on those investments?
Sure. So when we look at the 1-year return on the fund, we would say that it did 20.6% in a 1-year period, actually, last year. And how that translates to you, it's the gains that you see on the portfolio. So when you would get your statement, or if you check on the fund in that time frame, you would get an upward trend. And that would, again, be on the heels of what Kevin mentioned, which was that at the early part of 2020, when we saw markets collapse literally, you would have seen an overall dip in these funds, Global Growth Fund included. But once they were rebounding, then you would definitely be seeing that type of upward trend with the portfolio.
So Nerisse, are you saying that the price of the fund also moves? So when you say a 20% return, is it that the price per unit, I'm assuming that we buy a unit in this equity fund, so where the fund is priced has appreciated
absolutely.
by that 20%?
Absolutely, Sarah.
Okay, so this one is coming from Joel. And again, Nerisse, as our senior investment advisor, sorry to be picking on you, but
no problem.
How often should we rebalance our portfolio? What do you recommend in terms of rebalancing portfolios?
I mean, at least once a year. Some clients would want to have more contact with their officer. So it's definitely that conversation that you have on the outset with your client to see exactly how often they need to be touched, whether it's quarterly or semi-annually. But definitely you need to review once a year, see exactly what would have happened in that time frame, what profits would have gone into the portfolio, what losses you would have had and why. And just to check and adjust if there needs to be any rebalancing at that point. So,
Nerisse, in terms of getting started, how much, this question comes from Dwight, how much can he start investing with?
Okay, sure. So Dwight, our minimums, 500,000 Jamaican, 5,000 for the major currencies, so US, Canadian, Euro, Sterling. Those are the minimums to start.
Stanley, this question comes from It's Gregory on IG. Does the JSE only admit Jamaican companies?
No.
Sorry, Stanley, we're not. Can you unmute your mic?
Yeah, man.
Oh, there we go.
Yeah, man. Right. So there are two markets. There's the main market and there's the junior market. The junior market is primarily for Jamaican companies. Because as I've mentioned before, there's a tax benefit that it offers to companies who are listed on that market. The main market is open to any company that wishes to raise equity in Jamaica.
Thanks, Stanley. Just to go back, Nerisse shared some information with us about how we start investing and shared with us some minimums. But suppose, I'm building, right? I don't necessarily have the 500,000 minimum. Can you give me some advice in terms of how I can start to save to get to that minimum? Is there any support I can get within Scotia Bank itself before I transition to Scotia Investments?
No, absolutely. So the systems that Scotia has in place are really excellent in terms of supporting someone who wants to set up a consistent saving plan. So if your aim is to start an investment account with us, but you're not quite there at the minimum, then definitely have a set standing order that you set aside every single month that is designated for the purpose of saving towards your investment goals. So I think that's important, and you really have to be consistent and diligent with it as well.
No, I love that advice. I mean, the standing order instructions, I think, is key. In terms of the approach to budgeting and saving, they always say pay yourself first, right? So I love that recommendation about just doing a standing order, put away your savings, and build so that you can achieve your investment goals. So this next question comes in. It's coming from Making Life Mine on IG, and she's asking, what is risk tolerance, and how can I figure out what mine is? So, Nerys, what are some of the approaches you take in helping clients discover what their risk tolerance is?
Sure. So you can use some illustrations. So one of them, would you consider yourself high risk? Meaning, would you skydive, or would you have to be tethered to something like myself? I can zip line, and that's about as much risk as I can take. But really, it's looking at for yourself. And I go back to the same example I used before. If you get your statement today and your portfolio is down by 20% or 15%, how do you feel in that moment? Imagine that. And is it too much for you to bear? You know that I cannot take even a 10% downturn of my portfolio. Then that guides you, that gut feeling, about how you want to place your funds. Now, I say that, but I also want to add a caveat. There are customers that come all the time and they say, I cannot take on any risk, Nerys. I'm risk averse. It has to be low risk. We have the conversation. We set up your profile, and you can take a little bit of risk. So it's always about calculated risk, and that approach guides the conversation and the options that we will include in the portfolio for you.
So, Nerys, just to close off our Q&A session, right? This last question comes from C. Smith. And they ask, what would you say is the most important rule to investing?
I would say always come back to your why. There are times when the market is down, or even when it's up, and you want to step away and pull your funds at that point. But the why, the reason that you're investing, is always key to remaining investing, right? So you always want to diversify, stay invested, and consistently add to the portfolio as you can.
Great, thank you. Thanks, Nerys. Thanks for that
Thanks so
great
much,
advice,
Sarah.
invaluable advice. So guys, we are wrapping up our session today. I think it was a very productive and fruitful discussion. I really want to thank my panelists. Before we leave you, I want to share some key takeaways, right? One, Scotia Investments. We have a capital markets team that has the expertise and track record of developing innovative equity solutions for both corporate and sovereign issuers. So that's myself and Stanley. We can help to take you to market and raise capital in the equities market. Other key takeaway from Kevin, right? When we are evaluating and considering these offers that are coming to market, make sure you familiarize yourself with the key terms outlined in the prospectus. We need to understand, what is this company's strategy? Let's look at the management, and to the extent possible, what has been their track record. Lastly, before you make that investment decision, make sure that you speak with a licensed advisor like my colleague here, Nerese. Make sure that you speak to her so that you can feel comfortable and understand how this investment option aligns with your ultimate goals. So with these key takeaways, I think that our audience would be well prepped to look at evaluating the next offers that come to market. We do want to thank everyone for joining us here on Scotia Live webinar series today. A special thanks to our panelists, Nerese Pottinger, Kevin Walters, and Stanley Thompson. We are available to respond to any additional questions that you have for us. Just please send us a direct message through our Instagram page at Scotiabank Jam. Thank you for choosing Scotiabank.